Most people think there are only three types of home loans: FHA, VA, and conventional. But that's like saying the only food groups are burgers, pizza, and sadness. So there's a whole other side of mortgage world built for people who don't fit neatly inside the box. And no, I am not talking about those sketchy TikTok, no income, no credit check scams. These are legit regulated programs that can make the difference between being denied and approved. So let's go through a few. Number one, bank statement loans. If you're self-employed, photographer, contractor, realtor, small business owner, you already know tax returns never tell the whole story. Bank statement loans use your actual deposits instead of taxable income to qualify. We look at 12 or 24 months of bank statements to determine what you actually earn. No fake write-offs, no frustration, and I don't have to explain your accountant's creativity. It's one of the best tools for self-employed borrowers who make solid money but show very little on paper. Number two is DSCR Loans. Debt Service Coverage Ratio is what that stands for. This one's for real estate investors specifically. Instead of qualifying you personally, a DSCR loan qualifies based on the property's ability to pay for itself. If the rent covers the mortgage, taxes, and insurance, now we're in business. There's no W-2s, no tax returns, and no explaining side hustles. It's all about the deal, just not your day job. Perfect for building a portfolio or even buying short-term rentals like Airbnbs. I do have a couple of programs where we can even use Airbnb income to qualify for these. One big frustration people find with DSCR loans is the expected rent on long-term rent doesn't necessarily cover the ratios. So if you have one of those, definitely reach out. Number three, no ratio or asset-based loans. This one's big in Arizona in particular. Retirees, people living off of investments. You guys typically don't have regular withdrawals. You just spend money when you need to, so it doesn't look like you make consistent income. So if you've got cash, assets, or investment income, you don't need to show a consistent monthly income to qualify. Instead, we look at your assets to prove you can afford the loan. It's a smart option for people, again, with strong financial positions, but irregular monthly income. So again, early retirees, business owners who sold a company is a big one. Trust income borrowers is the next one that I typically use this one on. Number four, non-QM, non-qualified mortgage. So all these fall under non-QM category. It doesn't mean a non-qualified person. It just means they don't fit the Fannie or Freddie exact guidelines. They're designed for real people with real lives who earn money in unconventional ways. They usually come with a little bit higher rate, a little bit higher requirements for down payments, but for the right borrower, they're a lifeline. That's all you got. Some closing thoughts for you on these. The mortgage world is not black and white. It's not just Fannie Mae or bust. There are legitimate, fully documented programs built for people who are successful. They just don't get paid in a W-2 world. So if you've ever been told you don't qualify by a big box lender, what they really meant was we don't offer that kind of loan, and there's a big difference there. If you're self-employed, an investor, or someone with non-traditional income, just reach out. I'll help you find a loan that fits your life and not just the lender checkboxes that we typically used. I'm licensed to do loans in Arizona, Oregon, and Washington, and I look forward to helping you out.